Hello and welcome. You're watching KYC. This is a show designed to give the regular investor powerful, actionable insights into the fundamentals of a single NSE listed company daily. We're talking about V-Mart today. Interesting because in the retail space, it's a crowded space in that sense. But at the same time, this one is engaged in the business of value retailing. So tier 2 and beyond is what they focus on in terms of geography. They have 488 stores. Pretty much all of the stores are on lease. And you know, while I'm speaking about this, you'll start to understand how cost structures within the company are also working. So all stores are currently leased. They have a strong presence in UP, Bihar and Tamil Nadu, and therefore a larger focus on tier 2 and beyond cities. Now, in terms of store formats, and this is interesting, they've categorized their store formats into 4 or 5 verticals. One is the V-Mart Aspire. The format caters to young generation. Focus is to provide Gen X the latest trends in fashion. Then there's V-Mart Plus. The store caters to all age groups, and they're serving the basic needs of customers and providing contemporary fashion as well. Then there's V-Mart Corporate. Here they're focusing on 22 to 25-year-olds. That's the target. And they're serving again the fashion needs as well of these. Then there's V-Mart Values. And these stores largely cater to all age group formats, focusing on basic needs. So this is pretty much covers all age groups. The last one is LimeRoad, and this is the online fashion marketplace of the company. Currently contributes just about 1% of top line, so not major in that sense, but nonetheless a good possible lever where they can push growth higher, because it's an omni-channel, and omni-channel is generally where the sourcing is done in a common warehouse, and thereafter you are distributing to both stores, which is retail stores, brick and mortar, as well as doing online. So that's broadly the model they are following. Store count. This is how their store count is split. Largely, as you can see, tier 2 and beyond. Maybe they have nearly 370 of their stores out of the 488 in tier 2 and beyond. That's the larger focus area that they are currently working with. They have a larger focus on being low cost and in terms of their revenue mix, just about 1% from LimeRoad. So probably that's how their revenue mix is structured currently. And I'm interested to know how quickly they are able to ramp up on LimeRoad 1 and Unlimited, which is the other piece. So channel mix is something that I'd be keen to also understand better as to how they are looking to pick it up from here. Now, in terms of how we're going to break this down and metrics that we're going to look at for a V-Mart retail, let's look at all the metrics that we're going to look for. One, we're going to look at income statement, balance sheet, cash flow, and shareholding. So, of course, the key ones. But along with it, we will also look at a street cred, valuations, analyst recommendations, and your outlook in terms of what's their growth target, etc. So we look at all of those as we assess this company, and thereafter we'll go across and speak with or have a look at the conversation we've had with the management. Let me first bring on Mahima Vashrajani, who tracks retail very, very closely for us, and she's going to give us a breakdown with regard to the income statement. Mahima, over to you.
Right. So overall, the income statement picture is on a positive trend. If we check the 4 parameters, that is your revenue, your EBITDA, your margins, as well as net profit. In terms of revenue, the 9 months FY25 numbers stood at roughly 2,400 odd crores, which was around 2,700 odd crores in FY24. So the 3-year CAGR has been around 37%. But you know, as we were discussing earlier as well, Harsh, if we exclude the COVID period, the overall 3-year CAGR, that is trailing 12 months basis, has been around 23-24 odd %. In terms of EBITDA, the overall CAGR has been roughly 17 odd %, which stands around 309 crore rupees in 9 months FY25. In terms of margins, they have improved as compared to FY24, where margins stood at 7.6, and they've now improved to 12.5%. Margins overall in FY24 were also affected by the overall acquisition and implementation and execution of LimeRoad. But this year specifically, the company has taken cost initiatives and has focused on margin expansion as well, which is why we are seeing a significant uptick in the margins as well. Net profit, well, this is the year where company so far has been profitable. Otherwise, FY24 was a loss of around 97 odd crores. This year, till now, 9 months FY25, the company has seen profits of around 27 odd crores. Of course, we'll wait and watch out for as to how the fourth quarter pans out and whether the company stays in that profitable range or not. In terms of operational metrics, well, average transaction size, overall, if we compare for the two categories, that is V-Mart and Unlimited, 9 months FY25, there has been no growth as compared to 9 months FY24. It has remained within that 980 odd range. Unlimited has, in fact, seen a decrease in the transaction size, which was around 2014 versus that of 1797. And overall total also, there is a tad bit of decline when it comes to average transaction size. Average selling price, however, we've seen that the total average selling price for V-Mart for the entire company stood at 234. For V-Mart itself was 216, and for Unlimited it was around 431, where total is concerned. In terms of conversion rate for 9 months FY25 versus that of 9 months FY24, the conversion rate has significantly gone up. It stood at around 39 million in 9 months FY24, which has gone up to 56 million. In terms of other operational metrics for 9 months FY24, double-digit growth in terms of same-store sales growth at 12%. Volume growth also stood at 10%, but this is lower as compared to its peers like V2 Retail. Stores count stood at 488, as Harsh also mentioned earlier. Sales per square feet stood at 729. And overall retail space right now available for V-Mart, something like a V-Mart retail, is 4.2 million square feet, which as compared to V2 retail is much lower, because if I correctly remember, for V2 retail it was around 17 million square feet. So overall, operational metrics to some extent are improving, and in terms of revenue as well as being profitable, the company is making its contribution towards turning profitable and also taking cost initiatives to expand the margins as well, which is why we've given a thumbs up right now. But operational metrics as compared to peers, Harsh, are definitely a little lower as compared to something like a V2 Retail, which has seen a good growth in terms of same-store sales growth as well as volume growths.
Yeah, possible, but a 12% same-store sales growth in an environment where we've seen a bit of a drag where retail is concerned.
Absolutely, and where large players like Aditya Birla are not even doing single digits, high single digits volume growth.
Correct. It's not looking all that bad either. So, and therefore the thumbs up justified, and the kind of growth clip that they've done, 23%. Even when I'm looking at trailing 12 months currently, so maybe in Q4 you'll have a stronger number. Mind you, Q3 was their strongest top line that we've ever seen from a V-Mart retail. So maybe Q4, if they're even able to replicate that, the numbers will be starkly better. You'll roughly go at an annualized 4,000 crore kind of top line clip, which is fairly decent in terms of growth overall. So yeah, so some things to keep in mind. Let's look at the balance sheet. Now, in terms of net worth, the net worth has actually come off over the 6 months because we've seen a bit of a loss which has crept in the first half of this year. You've also seen debt go up. Mind you, we spoke about the acquisition of LimeRoad being a bit of a headwind with regard to numbers. That seems to be starting to even out now. And therefore, these numbers may look a little weak at the outset, but likely some of these numbers may start improving very, very quickly. And nonetheless, the numbers at the outset don't look all that bad. So for the gross debt to be around the 155 crore mark even at this point doesn't look bad at all.
But in fact, sorry, stepping
please.
in, they've also given the scenario for 31st December in their recent, presentation, and the debt has come down to around 35 odd crores. So that debt
Correct.
has significantly come down.
Correct.
And
so that's at the end of 9 months.
End of 9 months.
So the number looks different at the end of 9 months. But if I were to compare net worth, gross debt, and cash as of September H1 to 9 months, we are seeing that there are improving metrics which are playing out.
Correct.
Also, for gross debt, even say, for example, to peak out at 155 crore on a 2,500 crore market cap doesn't look too severe in that sense,
Correct.
given that it's a retailer. Also, they don't own the land, or they actually lease the land on which they build the store, which makes it easier for them to be able to drive operating cost as the number. And therefore doesn't require very heavy capex either in that sense. Okay. So therefore not surprised that the debt is at that number, but looks reasonable, and therefore the thumbs up. You want to take up cash flow?
Absolutely. So the cash flow position right now, we've given it a neutral rating because overall, if we see the numbers, as compared to how they panned out, we have the updated numbers as well for this as of 31st December 24 and 25 as well. And but before that, you know, the numbers in terms of operating cash flows are slightly have gone down, but this could be because overall inventories would have gone up. You know, they will be stacking up for festive season, which is why. So overall, when we see the picture at the end of FY25, we'll definitely see that increase in operating cash flows and net cash flow. Overall, in 9 months, FY25 has turned positive, which was negative in FY24. So net cash flow position is also improving, but at a very lower pace, which is why we've taken a very optimal approach right now and conservative approach, and given it a neutral rating right now.
Yeah, absolutely. And it's also LimeRoad, right, Mahima, which we spoke about, which has impacted some of these numbers. Of course, Q3 has been on an improving trajectory. Can Q4 continue to sustain that will essentially be the question. Let's look at shareholding very, very quickly. Now, in terms of how the promoter shareholding has panned out, it's at 44.3% currently. Your FIIs have trimmed their stake a little bit versus March of 22. DIIs have in fact hiked stake, and very, very substantially. Public shareholding has gone down. But broadly, promoter shareholding being largely stable over maybe 2.5 years, where we've seen a very decent rally in markets as well, giving some amount of support to the fact that promoters still hold a chunk of the company. So 44.3% in terms of the promoter stake. We'll give this a neutral, but nonetheless, it's decent in terms of the promoter holding. Mahima, with regard to street cred.
Right. So street cred, in the past 1 month, the stock has been down by about 2%. 6 months, the stock has seen a hit of around 27%. This is despite the kind of performance that it has given in Q2 and Q3 as well. 1 year, the stock is up by about 39% and 5 years return for the stock has been around 97%. So since we've seen a downtick in the past few months, it's just that reason because of which overall we've given a neutral rating. But of course, this downtick is on the back of the market sentiment as well as to how the markets have panned out in the past 6 months, and we've seen that the mid caps and small caps have taken a significant hit as well. So overall, again, taking a conservative approach here, we're giving it a neutral rating, but overall the stock has done well in the past 1 year.
You want to also take us through valuations? Sure.
So in terms of valuations, if we see the EV to EBITDA for 12 months trailing, we've not taken PE here because the stock has seen losses before. In terms of how it pans out versus its peers, well, V-Mart right now is placed at a slightly better position than something like a V2 retail or something like an Aditya Birla fashion. But having said that, the EV to EBITDA for 12 months trailing does not look cheap right now because it's trading at around 24 odd times. It will go to around 19 times going ahead in 2025 and further come down to 14 times in 2026. So 2 years down the line, as per Bloomberg consensus estimates, it will come down to around 14 times and that will be in line with where V2 retail will also be trading at around 15 times, and Vishal Megamart, however, still will be expensive at 27 times. Aditya Birla Fashion is something that will also come down to around 16 times. So it's a space where the competition is tough and the valuations also are looking similar where peers are concerned. So overall, considering that valuations are in line with how peers are trading at, we've given it a neutral rating for now.
And Mahima, just in terms of the valuation delta, FY24 FY24 versus FY26,
Right.
what we are seeing is that the delta going down very, very quickly because the
Steeply.
trajectory of growth is extremely solid. So looking at a decent growth clip, that's one way to probably look at it. V2 retail may be growing slightly faster, but of course with it comes its inherent risks as to what happens if they don't clock in the numbers that many are expecting them to clock. Vishal Megamart too, largely in terms of the way the trajectory is moving, there seems to be a decentish growth, but AB Fashion and Shoppers Stop, what we are largely seeing is growth isn't there. Just look at the way in which the move is in terms of how Shoppers Stop's EV to EBITDA lines up. For FY26, you are at 6 times. FY25 is a year where there's no growth. And basically, that is a bit of a concern. But quickly on to analyst recommendations. Just 2 analysts with a buy rating, no hold, no sell, potential upside is 36%. The number of analysts having or very low in that sense, being it's not as well covered. We'll give this a neutral. We'll go with a neutral on this one. Quick correction, the return potential is 36%. So very solid return in that sense, but just 2 analysts covering it. Now, in terms of outlook, Mahima, what can we expect and what is it? A thumbs up or a thumbs down?
Right, it's definitely a thumbs up. The management has said that it is targeting high single digits growth, mid to high single digits growth going forward. They're focusing on maintaining the margins at where they are right now. They're also enhancing customer value propositions, and they'll continue to invest in technology to improve overall operational efficiencies. They're also taking initiatives to integrate digital solutions at store level, which will overall improve their inventory levels, and they're also targeting to improve their inventory levels at least by 5%. And lastly, they'll maintain their store count, but at the same time, they'll also ensure their profitability is something that the management has said in the con call. So this is the overall outlook that the management has guided so far for V-Mart Retail.
Okay, interesting. Let's quickly pull up our rating for this one. As a result of all of this, we give it a 5.5, but how does it play out? Income statement, balance sheet, cash flow, shareholding. So 3 over here, and then you have 2.5 coming in from the others. You've got 3 neutral, 1 positive, no negative. That's the other thing that really stands out for me. So 5.5 in that sense. Let's shift focus, hear from the management. We spoke with the CFO, Anand Agarwal, and here's what he had to say on the company's growth prospects ahead. Listen in.
I think the trends are looking slightly positive. I would say that coming at the backdrop of post-COVID correction that we saw for the last 2-3 years, last 1.5 years especially has been quite positive. There's definitely far better traction that we are able to see in terms of the customer footfalls, in terms of the customer sentiment, and also therefore the throughput that we are able to see in the numbers. But having said that, I think a large part also is to come from the efforts that as a company that we have taken to improve our product offering to the customers, the way we source, the way we buy, what we buy, how we design, how we price, and all of that. So there's a large part of work that the company has been doing for the last 2-3 years, which is also now reflected in the results that we are now able to see. But at an overall macro level, I think we still remain quite confident at the overall opportunity. I think the market may not be very, very strong, but definitely is better than what we had seen in the last 3-4 years.
Right, and overall in the past 2 quarters, we've also been seeing that there's a double-digit like-for-like growth. Volume growths are also in double digits. Do you think that this is a new normal for V-Mart Retail, and going forward, the growth is going to be higher when like-for-like growth and volume growth is concerned?
While I take your compliment, I think it is definitely a good growth. We've grown at double digit so far, YTD in the year. And I would definitely want to maintain or grow even better. But I think more on a sustainable basis, one should look at a single digit, mid-single to high single digit kind of same-store sales growth going forward. But at an overall company level, I think we should still be looking at mid to high teens overall total sales growth for the next 3 to 5 years. And that's the effort as a company that we are trying to build on in terms of our offerings and how we look at the growth opportunity. While the opportunity remains very strong, but we still are more focused on profitability growth rather than just the top line growth. So our efforts will be more on making sure that our profitability growth is higher than the overall total sales growth.
Okay, and Mr. Agarwal, in terms of competition, of course, from the listed players and the unorganized space, because in the past few years, we've seen a lot of, the e-commerce platforms coming in, something like a Meesho, which are now providing what you provide generally at a lower price point. How are you viewing that competition, and what is the kind of strategy in place?
I think there's a lot of opportunity for all kind of players. We've also been trying our luck in the online space. We've also had our online marketplace platform called limeroad.com. But I think our experience so far has been that in this highly competitive price segment of around 300 rupees average selling price, it's extremely unprofitable and very difficult to operate a pure online business only for apparel. We still remain very buoyant on the brick and mortar story in the markets where we operate, but we still see online as an opportunity. At an overall level, I think the competitive intensity is only increasing, and that is also helping increase the overall size of the market. So the organized share of the market of the retail pie has been growing. A large part of that has come in from the growth of the competition and also the way we have grown. And I think it only helps to increase the overall size of the market for all players to thrive in.
Okay, and when you say that going online is not cost effective, does that also mean that tying up with other e-commerce and quick commerce platforms is also not cost efficient for you because of the price points that you operate in?
So in the fashion segment, online still is a relevant segment, but at the higher price points. But for the quick commerce, at least our experience so far has been that in the smaller towns and even in these larger towns, the fashion as a category may not be the most conducive product to be offered on quick commerce. But having said that, we remain very buoyant on exploring that as well as an opportunity. But at least so far, we have not seen a lot of traction coming in from quick commerce in the fashion apparel segment. But we will still want to explore and understand how we can operate in the quick commerce segment, and we are doing some pilots with some of the players in some of the non-apparel categories.
Okay, in terms of store expansion plans, what are the plans looking like, and what's in the list?
So I think we should be looking at adding at least 50 to 60 stores every year. This year also, I think we're just about to close, so I can't really comment on the numbers right now. But I think going forward on a sustainable basis, we should be looking at adding 10 to 12% area addition every year. So for the next year, that should translate to roughly around 60 odd stores, and the year after that, maybe 10 more. But yes, I think 60 plus stores per year yearly addition is a safe number to take.
Got it. And in terms of the overall growth, when we see your revenues also as compared to March 2021 overall to how things panned out in 2024, the growth has been quite steep. Do you expect this growth to be better than how it is performed in the past, and at what CAGR do you expect your revenues and overall bottom line also to grow with?
So I think in the last 20 years, we have grown at a revenue CAGR of almost around 17-18%, and that's something that we would want to maintain for the long term in the future as well. And similarly, on the profitability side, our entire effort and focus of the organization is to make sure that we remain a very profitable organization, and therefore our the profitability CAGR should be much higher than the sales CAGR. So I can't really exactly specify what is the number going to be, but we will definitely want to outdo the sales number or the sales growth number as far as the EBITDA growth is concerned. So we're looking at more sustainable and profitable growth in the future, and not just revenue growth to look at the top line.
Got it. And in terms of margins, one last question. Margins have also improved, right? 2 years down the line, do you expect an expansion on these margins, or do you expect to remain with them within the same range?
I would definitely expect, and we are working towards making sure that the margins come to more healthy and more sustainable levels. And the entire effort is to make sure that our sales per square feet and therefore the total sales improves. And in the retail business, almost all of the costs are fixed costs. So therefore, one should look at some amount of operating leverage. which should come in the form of improvement in the margins. And in any case, we would want to come back to the margin levels that we used to enjoy pre-COVID. And that is the first target that we have taken for ourselves. So in the next 2-3 years, I think we should be looking at similar kind of numbers in terms of margin growth.
Right. So that was around 13 to 14%, if I'm not wrong.
No, at a pre-Ind AS level, that used to be around 7 to 8% pre-Ind AS, and post-Ind AS, it would be around 13-14%.
Right, that's all the time we have on this edition of KYC. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Hope this was helpful. Stay tuned. More action on the other side.